I'm Keith McCullough, and welcome to our 13th semi-annual Investing Summit. That's a lot of real conversations that I've had the pleasure of having. There are plenty of things that happen that I don't know are going to happen. Revealing Sam Bankman fraud was a big one, for example, with Mark Cohodes. But it's so many of the learnings that we're going to have in the next couple days. Hopefully they're unique to you. The people that we've chosen to have on these real conversations have something very unique to offer, and that's why I wanted to start with Dan Rasmussen, because he has his own framework. I think I could start by saying hello, we are from the future.
Thank you, Keith.
But first, and as a matter of principle, I mean, you start with your framework.
Yes.
People, you may or may not know that Dan has a book coming out called The Humble Investor. That's coming out, I believe, in the new year?
Yeah, in February.
Oh, look at that. There's the cover. I told
Keith.
you, I love that cover. But again, this is a thing the world needs. You know, the world needs to know that there's another way, like versus 60-40 at a bare minimum.
Yes.
But there's a better way.
Yes.
And a better way doesn't just have to be my way or your way, but it has to be a lot better than what I affectionately call the old wall.
Yep.
And all target date funds, again, 401ks, retirement accounts, they're largely stuck in the other way. So maybe, and welcome, but take a shot at that. Like, what got you to write the book?
Yep.
Because the biggest thing that I actually think even wrote this in part of in my comments about the book, it's rare that a buy-sider has the courage and/or wants to even open up the kimono and say, hey, look, this is what I do.
Yep.
Right? And that's super valuable because most people keep it to themselves.
Yeah, I think that one of the things that attracts me, I think there are two big things that attract me to you, Keith, that I think we have in common. I think the first is this idea, I call the book The Humble Investor, and this idea of humility is really about saying, that a lot of things about the market are unpredictable. It's very hard to get the markets right, but one thing that we can get right is human error. Human error is predictable, and you see these cycles of overconfidence, of over-optimism about certain companies, excessive pessimism about others. And when you start saying, hey, gee, I don't know what's going to happen to the market, I don't know what's going to happen to X, Y, or Z stock, but I can really assess what the sentiment is. Mm-hmm. And if I can understand that sentiment, I can bet against where consensus is just way too optimistic, too confident they're right, and start to take the other side of those bets. And I think a lot of that is rejecting what you called old wall. All these the narratives that fuel excessive speculation, that pump and dump, that cast aside certain things but to hype other things. And I think the more you can expand your purview and say, hey, let's even before I start to dig into the fundamentals, let's just understand the sort of spectrum of opinion, the spectrum of consensus opinion, and am I looking at something that's way overhyped and way consensus, or am I looking at something that's way out of favor? And try to garner from those signals something actionable. Mm-hmm. I think the second thing is that I've been very focused since the beginning of my career. I didn't take finance courses in college. I came to this sort of as a self-taught guy, trying to figure out how to make investment decisions. And one of the things that I really try to do is to say, well, I want everything I do to be based on some sort of logic, like some sort of set of rules or principles that are going to guide my decisions. I don't want to just do X because X seems like a good idea at the time. I want to do X because doing X consistently and repeatably over time makes sense. And I think your obsession with process and my obsession with process are very equal, and I think we come to a lot of similar conclusions, right? Because I think when you start to look at data and you start to study the past and try to figure out where things are rhyming, you come to some similar broad conclusions. Now, we have our differences, and certainly differences in our processes, but I think that adhering to a process is the only way to navigate the world of investing, and it's also the only way to expose the hubris that I talked about and sort of contrast with humility, because unless you have a framework to say, how do I evaluate what's true, how do I evaluate what people are too optimistic or too pessimistic about, you're never going to be able to react fast enough to make good decisions in real time.
Yeah, this is where I know it's going, because we're already here. I mean, it's not like you're new, and neither am I. We're not as young as we used to be, and God willing, I'm on the right side of the grass for a while to go yet. But if you think of this, like the future is people actually showing their process, the repeatability of their process. What you're going to find, just like any professional sport, just for starters, is that in principle, Kobe Bryant was like Michael Jordan, but Kobe Bryant and Michael Jordan are dissimilar.
Yep.
Right? They had very good process, very good discipline, very maniacal about those things. And Yeah, I think that that's the point on it doesn't have to be your way or my way, but in principle it has to start from a different place.
Yes.
And that's, so one, there's that, let's dig into your process versus a 60-40 at a very basic level so that we can kind of start from there. And secondly, I love this term that you use, you call it people being predictably irrational. Right? People hear, oh, I've already irrational exuberance, this is, this is this and this is that. But maybe start with that and then we'll go back to the process. But predictably irrational, your process is designed to pick off predictably irrational behavior.
Yes. So let's start with equities, right? Within the world of equities, there are some very simple ways to look at this, right? One is just to say, take analyst consensus forecasts and array every company from the things people are most optimistic about to the things they're most pessimistic about. And what you find generally is that you fast forward a year, the things that people were most optimistic about just haven't lived up to expectations, and the things people were most pessimistic about have outperformed expectations very systematically, right? You just think about it. Does that sound logical? Yes, it sounds logical. Does it actually happen? Yes, it actually happens. How can you exploit that, right? That's one thing that I try to do with my value investing strategies. Try to say, okay, gee, if we know that this is a predictable error, let's try to find ways to systematically exploit it. And I think the nice thing about that is, I think there's so much training. You can go to business school, you can take the CFA, and you never find the word forecasting error. There's no like you go to the index and like investing mistake, right? And yet every person who's actually lived being an investor knows that 40, 45, maybe 50% of the time, the things that you thought were good ideas 6 months ago or 3 months ago were a mistake, that you made a forecasting error. And I think until you start from the premise that you're forecasting errors, if you're really good, you're going to reduce the percentage of them over time, but that everyone else is experiencing them. And if everyone else is experiencing them, why are we not talking more about how to take into account the errors that the market is making, right? It's sort of in contrast to efficient market theory. Efficient market theory says the price is always right? That what's baked into the market price is all available information. But you start to see the frequency with which markets swing in terms of price, it's just too volatile to justify the price being always right. What it actually is a consensus of people making mistakes and the truth coming out and surprising us. So I think that's the start of my sort of value investing approach. And then when I go to sort of thinking about multi-asset and thinking about, say, the 60-40 portfolio, I think there are two things that are, well, let's say, to make a good portfolio, you need to have some view on returns, you need to have some view on volatility, and you need to have some view on correlations. And what the 60-40 portfolio does is only take a view on returns in some sense, right? It's not taking a view on correlations, not taking a view on volatility. And I think that you have to do that, right? So I would say that the least predictable thing in the world is returns, right? It's really hard to know what the stock market's going to do next month or the bond market's going to do next month. Maybe you can get a tiny edge in some corners of the market sometimes. But volatility prediction is actually much easier. You can predict vol with some degree of accuracy, right? It turns out there's option-based signals, even trailing vol does a pretty good job. And if you think I have no forecast, no differential forecast on expected returns, let's say I just think the stock market returns 50 basis points a month. A month in which the S&P has a 10% vol is a meaningfully different Sharpe ratio than the month that has a 20% vol. And so if you're adjusting your portfolio based on volatility signals, which is what you should be doing, you're actually going to meaningfully improve your Sharpe ratio. Not because you're predicting the market any better, but simply because you understand volatility, which is predictable. And I think the next thing is correlations, right? And this is where the 60-40 portfolio, and I know we're going to get into some more along these lines, but the other thing about the 60-40 portfolio, the basis of it is that stocks and bonds are negatively correlated. Well, they are negatively correlated sometimes, but sometimes they're not.
Like recently.
Like recently, right? And I think, you think about a very simple substitute. You say, hey, gee, bonds are in my portfolio for safety. Generally, that's why I want them there. Negatively correlated to equities, and they're there for safety. Well, when stocks and bonds become positively correlated, as they do when there's inflation, what if you just subbed out the bonds for gold, right? And we said, hey, gold is a safe asset. Gold does pretty well when there are big flights to safety and panics. Why don't every time the stock-bond correlation goes very positive, I sell all my bonds and buy all gold, 60 stocks and 40 gold, right? Well, that turns out that very simple strategy would be a very good idea.
Yeah.
And again, you're not making you're not taking an explicit view on returns. You're just saying, I want to construct a better portfolio. And I think the next thing that I think is really important, following on that correlation thing, right, is uncorrelated or diversifying assets are extremely important. Because the more diversifying assets you can add into your portfolio, the better your portfolio is going to be. And so, people are so myopically focused, and even more myopically focused on the S&P 500, and then some total bond thing, which they haven't really thought through very well. And the minute you can go outside of that and say, hey, gee, what are some less correlated areas of the market that I can add into my portfolio, you have such a meaningful and dramatic improvement in your ability to construct good portfolios, especially if you're taking into account the volatility and correlations in constructing those portfolios. So that's the essence of my process.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
It's interesting, like on that scorecard, which would be similar to mine, like I would never consider investing in anything if I didn't look at the volatility attributes of that thing.
Yep.
It's the most basic relationship in life, in the universe, as it is in markets. When you shock volatility to the upside, you will be shocking the asset price to the downside.
Yes.
But taking that, the one thing 60/40 did get right was the vol assumption on fixed income just being lower, so they have a 60% fixed income is higher because it's got lower volatility.
Yes.
That's pretty much the only thing.
Yep.
And this was in a day and age that is far gone.
Yep.
Right? Never mind that you have so many different kinds of assets and liquid asset classes and alternatives that you could go with. But if you just take that, again, return vol correlation.
Yep.
Return, the way that I think about this is, and why it is, like why everyone's watching CNBC, watching the S&P 500, and that's what they think the market is. I'm not saying everyone. I'm talking about old wall.
Yep.
Everyone in the old wall, or
Yep.
as Nate Silver's recent book, which is really good, he calls them the village.
Yep. Yeah.
You, Dan Rasmussen, and I are not. We do not live in the village. We live,
And therefore, we're not villagers, which I feel like is a derogatory term.
You are a Riverian. You live in the river, right? You take risk. You take bets.
Yep.
You make explicit bets that are against the crowd, and sometimes you're betting with the crowd. You bet whatever you need to bet in the. He uses the river card as a poker analogy. But isn't it that the return that's what they want?
Yep.
That's what they need.
Yep.
Right. Whereas the volatility of an asset class is what you get.
Yep.
What you want and what you get are two different things. I mean, I personally have zero. I'm dysfunctional in this sense. I have zero care what asset class I own, provided that it has trending volatility breaking down on my signal. Therefore, the probability of the return is going to be higher.
Yep.
So, that, and then obviously we have the correlations that fall out of it. I mean, you generally are going to have correlation risk that falls in and out of where volatility is going.
Yep.
Right? So, do you agree with the premise on why they do it that way?
Yeah, well, I think it's what sells, right? And I think it's one of the most common mistakes you see in investing, right, is that people are very focused on trailing returns, and they buy into things that have been going up, and they sell things that have been going down. And there is a momentum effect, so that's not entirely bad, right? That's not entirely bad, right? Of course, we want to consider the trend. But it's the most common investing mistake. And that's why you see most investors today, the vast majority of sort of people that are influenced by the old wall machine, it's just all S&P 500, right? Get rid of international stocks, get rid of this. Why would you ever own precious metals? That's for nuts. I mean, you just get this sort of crazy focusing of let's get rid of everything, diversifying, because all I'm focused on is the S&P 500's amazing returns, and the returns have been amazing on the S&P 500. And I think that's that sort of focus of attention. People are too distracted and they look entirely at trailing returns, because in some sense it is what you want, right? That's why you invest. You invest to make money. Well, what's the simplest way of knowing whether someone's making money? Well, did they make money over the last year, right? Did they make money over the last 3 months? And if that's true for, say, the S&P 500 of just beating everything for months and months and quarters, of course people are just going to abandon everything else and flood into one central asset class. And I think that's one of the big problems. And I think In contrast with just sort of chasing returns, chasing attention, focusing on where everyone else is focusing. The minute you start thinking systematically about volatility and correlation structures, you just see the world in a very different light, right? Because you're saying, gee, trailing returns in the S&P 500 don't tell me much about next month's returns at all. But volatility and correlation structures do, and there's a lot that's going on there that's actually very informative, and it improves your portfolio. Without you having to make some dramatic view on the world, right? Like you're not taking some dramatic bet on whether you think AI is overhyped or not hyped enough. You're just saying, hey, how does this asset's volatility and correlation structure fit within my broader portfolio? Is it going to help me achieve my goals? And I think that's a much better way to invest.
Yeah, I think Albert Einstein would agree. I don't think that anybody that runs an old wall firm can agree.
Yep.
I mean, if you show the quote of the day that I used today from Einstein, it is the theory that decides what we can observe, right? So in other words, your framework, your process, your lens.
Yep.
I can look at something and I will see something that's entirely different. I don't mean a market.
Yep.
Like let's guys show today the breakout in Treasury bond volatility and the correlating breakout, which is not new, which came first in FX volatility.
Yep.
I mean, they're only the two of the biggest things that we're trying to solve for, right? But if you don't start every day, your theory is S&P go up, advertising dollars come in. You don't need to talk about this.
Right.
Galileo wasn't a thing either. He was apparently fake news.
Yep.
So. That, again, to me is the opportunity. It's to teach, it's to educate. We're younger than the old wall by a lot.
Yep.
Like I said, we're not as young as we used to be. But, that lens and that framework, I mean, to me, I think your book is going to be one of the few that puts it in English, I felt like that was like, you made the topic accessible. Because the reality is, when I say, hey, Mom, you got to, like, going to my cousin's wedding in Canada this weekend, and I'll have some conversations with my mom. One way to not have a good conversation with my mom is to talk about volatility and correlations.
Yes.
But there's a point to this. My mom, who's a retiree, an ex-teacher, was calling me for the first time in my career when that 60 part was going straight down, right? Because they put her in a lot of fixed income. She's 70 years old, right? And she couldn't understand it. And if I keep saying it's the volatility and the correlations, Mom, it's the quads, it's the cycle.
Yeah.
She'll be like, when does it stop?
Right.
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 So how, was that part of your mission in writing the book?
Yeah, and I actually think that, so I've always written and loved to write, and I think that one of the things that writing do is it clarifies your thinking.
Yes, fortifies your process.
And I've always said, if you can't explain, we have since the beginning of my firm, I've always had summer interns, and people say, why are you wasting time and money on having summer interns? And I said, it's actually training for me, because if I can explain something in clear English to a sophomore in college, right, if I can teach them the way I think, then I can explain what I'm doing to my investors. And what I've thought is actually pretty smart, because it's simple enough that I can communicate it, right? And if you can't answer the basic questions from someone smart who doesn't really know, maybe they haven't studied volatility and correlations, but they're sitting there for the first time hearing it and they ask some basic question you can't answer, right? You actually don't know the material that well, right? You don't actually know what you're doing that well. And so I think explaining, writing, presenting the research is so important to making sure your ideas are actually right. And I think generally, if someone doesn't understand what you're saying, it's your fault, not theirs.
Well, I think in general, I've been told things that I get told a lot of people tweet at me, right? At one point, somebody from the old wall, like simple moving monkey, one factor model type, they have titles and everything. They're brilliant, but they generally focus on the S&P 500 and what the Russell could or could not do on the chart, and they have no idea on those two things I just showed: fixed income, cross asset, like volatility analysis. He said, if we don't understand it, we mock it.
Yep.
Okay, well, that's pretty clear.
Right.
We can't understand fractal math. We can't understand similar sets. We can't understand why a Bayesian inference process is better than being a frequentist. Is being dumb going to be acceptable in the future? Because I'm constantly shocked at how long CNBC can exist. I mean, it's double Seinfeld's run as a comedy. I mean, it's not like, how long can you be that way with all of them long of AI?
Yeah. Well, but I think
if you look up any of these things on AI, they'll tell you they don't work.
But I think this is my thesis of my book, right? Is that actually the persistence of human error is much more reliable. Like, I'd much rather bet that humans are going to keep making mistakes and study why they're making mistakes, how they're making mistakes. What is it that they constantly do that leads them astray? And one simple one is, do you think in 10 years people are still going to get bought into hyped up narratives and overbuy certain sectors of the market or certain stocks? Yes, I do. I think that's never going away. And if you can find a way to consistently exploit that phenomenon, right? Don't say, oh, gee, I'm this much better at pricing certain stocks because my discounted cash flow model is right. Like, I'm a genius at forecasting earnings 3 years into the future, right? Which no one is. That's going away, right? How are you ever going to make money doing that? But if you can find a way to exploit the predictably irrational nature of people, the stuff that you and I observe every day, we observe people making investing mistakes every day. We make investing mistakes every day. We observe people buying into these crazy narratives every day. And that stuff is unchanged. You could go back to the 30s and see the exact same phenomenon.
Mm-hmm. How accessible do you think people learning an actual process is? Like, as opposed to just saying, okay, I believe Dan, I believe Keith, I'm going to give them my money because I believe that's a better way, versus them doing it on their own.
Yeah, I think it's really important that you walk through the principles of a process before you sort of make an investment decision. I think that's essential, right? I mean, I think that because no process works 100% of the time, and until you understand where a process makes mistakes or where perhaps there are internal conflicts in the process, you're not going to be capable of sticking with it for a long period of time, because no process is perfect. And I think there are places where, for example, we're looking at today's market, right? And I think there's, and I'm keen to discuss this, right? The big Fed rate cut, right? Mm-hmm. And I look at that and I'm getting two conflicting signals from different sets of signals. On the one hand, if you look at the history of Fed rate cuts, right, and you say, show me what happened after every Fed rate cut. What you generally see after every Fed rate cut, hard to make anything about stock returns, okay, so I'm not going to say anything about stock returns, but stock volatility tends to go way up after rate cuts. Why does stock volatility go way up after rate cuts? Well, because the rate cuts are either trying to head off a recession, in which case either the recession is avoided and the market booms, or the recession happens and the market crashes, or maybe they're trying to, maybe they now think inflation is over, and inflation is indeed over, so the market rallies massively, or inflation comes back, and right. But you're at these sort of turning points in markets when the Fed starts cutting rates, mm-hmm. and so you see a big rise in equity volatility. And in contrast, what you often see is a decline in stock-bond correlation, and that generally means it's time to buy fixed income again, right? It's safe to buy fixed income, mm-hmm. which sort of it seems very logical, right? The Fed started cutting rates, good time to buy fixed income, right? And that sort of first order analysis seems, at least historically, within the range of studying prior rate cuts to be correct. On the other hand, we look at our macroeconomic signals and we don't see inflation being beaten, right? In fact, we see some reacceleration in inflation, right? You can see the CPI nowcast numbers, you can see the rally in oil. These are not things that imply that inflation is over and it's a great time to be cutting rates. And if inflation's not over, gee, you don't want to be buying bonds. Exactly. You want to be buying oil, you want to be buying gold, you want to be buying hard assets. Now, equities still look like a decent investment in both of those scenarios, right? Although, depending on how the volatility evolves, maybe you're reducing some of your risk. But I think that that's a moment where you can say, okay, gee, there's a logical process, right? Logical process one, study every historic Fed rate cut. See how it's impacted markets and make a bet that this is going to look similar or different to those. Or two, ignore what the Fed is doing, because the Fed is reacting to market conditions just like we are, and instead focus entirely on the macroeconomic signals. And where does that lead you? And right now, those things are somewhat in conflict.
Well, I mean, using your words again, predictably irrational, I mean, I think that's the Fed. Yep. I mean, the whole point is to front run the Fed. They have screwed up at every single turn in inflation, and they're screwing it up again.
Yep.
So the whole debate now is how many rate cuts? We need rate cuts to the vein, 60-40. Right. Because that actually would work if the economy is slowing and inflation is slowing at the same time. Call that quad 4.
Yep.
But if it's quad 3, I think this is what you're picking up on with all these questions. Quad 3, guys, if you show on slide 8, stagflation.
Yep.
And these are rank ordered, back tested returns on a quarterly basis that we're showing here. But number 1's gold. If you look at the big asset classes. Number 2 is commodities, to your point. And then it's fixed income. Fixed income doesn't get hammered, but it doesn't break out to the upside like it does in quad 4.
Yep.
Quad 4, you can see it's the number 1 and gold's number 2. So gold's along either way. That's why you've done well with gold, because we just came from quad 4 in Q3 to quad. We think it'll be a sustained and we agree, a reacceleration in inflation. On that alone, I mean, the only thing I can predict about that is that people are going to lose their shit. We just saw that. That move index move is the biggest move in Treasury bond volatility since the pandemic.
Yep.
Right? So when you see something, I mean, that is not a buy signal for fixed income.
No,
right? All I've been doing since I saw that signal was
yeah.
sell fixed income. And I had so bloody much of it in the quad 4 period that it's taking some time to get rid of all of it.
Yep.
But can you, we'll just take that with what you want to say back, and your gold position, because your gold, I don't know if you're long gold miners, but you've done very well being long gold, which you would in either quad.
Yep. Yeah, and I think the gold trade, again, it was, at least the way our process works, was a relatively simple idea, which is just stocks and bonds are too positively correlated to make bonds a good hedge, especially at the beginning of the year, right? Later in the year, fixed incomes become more attractive as the year has gone by. But gold at the beginning of the year, you were looking at this and it's got a great negative correlation to equities, really strong trending returns, right? Everything's sort of telling you that gold's a good add to a portfolio. And the nice thing about gold is you're never going to get that badly burned, right? Oh, you bought gold, right? Yeah. Maybe you hold gold for 50 years and you say, gee, I only got cash type returns. But in the short term, gold is such a low volatility asset. It's a very beneficial add to a portfolio. I think fixed income has been a lot trickier to trade this year, and I think it's this recent move up in volatility is making that even more so.
Well, it gets less tricky if you just listen to the bloody market. If all you do is look at price, volume, volatility together, like my signal, you will not screw that up. You will get hurt at the turns, but if you don't understand that pain is signal, you don't get it.
Yep.
Because what people typically do, and I definitely value investors will do this, is that pain becomes their bedroom.
Yes.
Like that becomes, and then it becomes their prison.
Yep.
Because that pain, I'm going to get this right. And they'll stay wrong and they'll add to it. Been there, done that multiple times.
Yep.
Can you talk about that?
Yeah, I think that the nature of sort of a cross-asset type of investing approach is that these turning points, exactly as you're saying, these turning points change your signals, and you have to react to it. The multi-asset portfolio is a reactive stance, right? You're not necessarily. It's very hard to forecast when these turning points are going to happen. But you can see them, right, just after the Fed rate cut. Huge move in the stock-bond correlation. Now that's ticking back up, right?
Yep.
But you have to be more frequently trading because the signals that you're trading move fast. And if they didn't move fast, it wouldn't make any sense to adapt your portfolio. You just have a fixed portfolio the entire time. But it turns out that volatility and correlations are both very volatile. Things change a lot. They change on a weekly, monthly, even daily basis. When volatility spikes, the signals change even faster. And so you are constantly reacting. And in this case, when you start to lose money, it's often a sign that your signals are changing, right? And I think that, again, that's different from, I also run value investing, just long-only value investing. And I think your point there is exactly right. A lot of those times you're saying grin and bear it through the pain. I'm not going to sell at the bottom. That's the type of thinking. But that's not the type of thinking that works in a multi-asset portfolio.
Yeah, it's two different things, right? And people on the old wall like to put everything in buckets, but we're not in buckets. The buckets move.
Yep.
Right? The whole point about asset allocation is you should be indifferent given the volatility characteristics of the asset.
Yes.
So that's good. Do gold miners do that at all?
I don't.
No, but you're long uranium too, weren't you?
I was not. No,
you
just
weren't?
gold. Yep.
Okay, gold. Japan. So you just got back from. He just told me you just got back from Japan. How good is that? Sushi's great, and that sounds touristy, but
It was fantastic.
How was it?
It was great.
Yeah.
I mean, and such an interesting time to be there. You had the big yen carry trade blow up, which was just so dramatic in early August. And I unfortunately had chosen that week to go on vacation, and my sister is an investor as well. And I said, I'm going to turn off my phone, turn off my computer for a week. And I get to breakfast on Monday morning. My sister said, "Did you see what happened in Japan?" I thought, "Oh no, there goes my vacation."
Was she with you?
Yeah, we were all on vacation
Okay.
together. So, and gee, that was a mess. But one of the ways I think about it, right, is that the entire market cap of Japan is about the same size as Apple. Right, so, you might look at a 12% dive in an entire country's stock market and say that's just insane, right? And this is the highest level. I think this level of volatility in the Japanese equity market has been reached only 3 times before. 2008, the Black Monday crash in the late 80s, and the Korean War were the only times Japanese equity volatility has been as high as they were this quarter, right? So this is a very crazy time for Japan. But a lot of it's flows driven. It's not driven by what's going on in the fundamentals of the market. It's driven by this yen carry trade. It's basically driven by these funding dynamics that blew up, just like a single stock could blow up in one day, entirely because of these flow dynamics. But what's interesting, we were there meeting with a lot of small companies to talk about corporate governance. Now, there's a lot of governance stuff which is just sort of fluff and PR, right? And I generally don't like the term governance. If someone's talking about it, you almost get a little suspicious. But what's interesting about Japan is that the latest reforms target stocks that are trading below 1x price to book. And there are thousands of companies, thousands literally of companies that trade below 1x price to book in Japan. So we were meeting with a bunch of them to sort of see what's going on and are they changing. And I'd say my two sort of overall insights from the trip are one, it's really bad in terms of what we're seeing in terms of capital allocation and what's on the balance sheet. We, just to give you one example, we went into a printing company, okay, the printing company, they do books, magazines, catalogs. They have maybe a 1% net income margin and negative 9% per year revenue growth in dollars over the past 5 years, right? So
that's value.
So that this is right. So you're saying this sounds like the worst company I've ever heard of, right? And I get it. But I was interested in it, and I'll tell you why I was interested in it. So we walk into the building, and if you or I were imagining walking into a printing company in the United States, you'd be in some Class C office building, the utter suburb, utter exurbs of some second-rate city.
Or we'd be at the Fed.
They'd be leaking. We'd be at the Fed, and we walk in. It's a gleaming, newly built office tower in downtown Tokyo. I sort of get a little suspicious looking around, like 2-story atrium. We've been at Goldman's offices earlier that day, and these were nicer, I thought. And so we sit down with the management team and say, I think it's a really nice office. And they say, oh yeah, we just built it. I said, oh, I just built it. And the market cap of this company is maybe 150 million USD. And I said, oh, how much did it cost you to build this office tower? I said, $100 million. I said, you spent $100 million building an office tower in downtown Tokyo, and you're a printing company. And then I thought, well, at least it's probably better that they built the office tower than they invested in their printing business. maybe it's somewhat better, but just completely crazy. And then we just walked through the rest of the balance sheet, and I said, okay, so you $100 million office tower, what else do you have on the balance sheet? And they said, oh, we have a lot of cross-shareholdings. This is a big thing in Japan.
Cross-shareholding?
Yeah, this is a huge thing in Japan where it's sort of a legacy thing where, if you did business together, say you're, in this case, the printer ink company, the company that sells the printer ink, owns 20% of the printing company. Okay. And the printing company would buy shares in one of its customers. And so it was sort of a way of signaling, they said it's holding hands together was one of the lines that described it, right? We're doing business together, we're going to cross-own each other's shares. And the Japanese government, one of the big corporate governance reforms is telling the people to sell these things because it's kind of crazy, right? Mm-hmm. So this Japanese company, 150 million of market cap, had over $100 million worth of public equity holdings in other Japanese companies, right? And so you're like, okay, you've got a $100 million office building, you got another $100+ million in shares of the other companies, and then of course every Japanese company loves to hoard cash, so they've got another 60 million of cash in the balance sheet just in case something bad happens. Which, if I were in the printing business, probably something is bad is going to happen. And you just walk through some of the stuff, and we had these kind of conversations. Say, hey, have you thought about selling? Some of the random equity holdings that you have? No. But then they said, oh, but actually the Japanese government is telling us to do it, so we're going to sell 1/3 of them over the next 5 years. And so, well, why don't you sell them all tomorrow? And so, well, what would we do with the money? And I said, well, how about a dividend? And they laughed. Like, never heard of such a thing.
Was this all with the translator, or was this?
Yeah, with translator.
Yeah, okay. They laughed.
Laughed, yeah.
Which is not common.
Which is not common.
Meeting there.
Yeah. And I just, and I look at that and I think, on the one hand, you just say, like, I could not imagine a confluence of crazier, like, more horrible things in terms of, like, thinking about a company. But on the other hand, you think, thinking about sort of the humble investor framework, right? You say, everything bad about this company and this company's governance and capital allocation is very well known, right? Like, I don't see how it could possibly get worse. And on the other hand, these corporate governance reforms in Japan are pushing these companies to do towards sanity. Are they going to move from where they are today to sanity? Probably not. but even a small incremental improvement over time could be quite dramatic. So I think it was a very interesting trip, and I think again these things are probably glacially slow in terms of how fast these corporate management teams in Japan are going to move, and the impact that's going to have over the next few years. But from where they're starting from, it is a little bit like 1970s U.S.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
I literally, in another meeting, it was an auto parts company. Again, these are value stocks.
And by the way, before you get on this, are you screening just value and then saying okay, and calling them up and saying okay, look, because you're definitely not calling Goldman and saying get me a meeting with the guy.
No, they kept asking us. It was very funny. Like,
how'd you find
we met with the banks and they said, who's doing your corporate access in Japan? I said, I don't know. Just email the companies, say like I'm interested in your share. Like you have to corporate. Apparently, there's this like something in Japan where you're supposed to go through a bank and get. Of course, that seems all silly to me.
But this is based on your valuation screen. This is too good to be true.
Yeah, we in Japan, we're looking basically at what's the price to book ratio is one of the most important things, right? And how cheap are these things? And their answer is that they're crazy. Mm-hmm. But there was another meeting where we walked in and we were talking. This company had 3 different segments, and they were talking about how they invest in each of the different segments. And we said, do you use any return on assets based metrics? Never heard of that. So we literally got a thing up on the slide deck, and we showed them how to calculate return on assets. You take the net income and divide it by the assets, and then you can see that this segment is a higher return on assets. You should invest more there. I mean, it was just shocking. And I don't mean to be so condescending. It's not like I'm some great genius here, right? These are very basic, like 1980. Like you got your MBA or like something, right? Like, and it's just sort of shocking the level of inattention to what are very commonly known things here in the U.S. are just totally ignored or foreign there. It just hasn't been a priority. Which was a very enlightening experience.
Well, this is, it's no irony that, when you think about book value and where something's trading relative to book, this is essentially a big part of Buffett's premise, isn't it, in going to Japan?
Yep.
And him, of course, because he has less time on the clock than you have, almost politically with his big hand forcing the expedition of this. Can you talk about that? And did that influence you, or you just end up in the same place?
Yeah, I think what Buffett's doing just makes so much sense, and I think that I'm a big admirer of what he's doing in Japan. I think there are others that are seeing the same things we're seeing. The question is it ever going to catalyze into change, right? And how fast is it going to happen? Or are you just going to be stuck with nothing? No change, constant disappointment. People who have been investing in Japan for a while know what disappointment is like.
Yes.
And I think I'm hoping that this time is different, that these reforms have teeth. And I think that the reason that they have teeth is that they're targeting these obvious balance sheet problems, the cross-shareholdings, the inefficient capital allocation, that are just easy, quick fixes, right? Like it's not hard if you have a $100 million market cap and $50 million in cross-shareholdings, well, if you sell the $50 million in cross-shareholdings, it's going to be good for your stock price. Yep. It's going to be good for your price-to-book ratio. And I think these simple reforms, because they're so understandable, because they're pretty simple and they're achievable, I think are going to have legs.
Yeah, it reminds me, like when I started in the business, you could actually, as a GARPy or even value investor, you could unearth some things.
Yes.
In the U.S.
Yep.
In particular in small caps.
Right.
Coming out of the 2000-2001 recession, small caps would be where they are when you go into a recession, which is on their ass. So that's interesting that you say it's more like the 1970s. I mean, the most recent, you get Ashiba, I think his name is in there.
Yep.
These are all starting to sound like coins to me. But the Ashiba comes in and tells the Ueda. I call him Skeletor.
Yes.
I try to give them like names. I said, guys, I don't know if you have the picture of Skeletor, but he's a beauty. He's the guy, of course, who runs the BOJ, right? And Shiba's like, dude, no rate hikes. So that flipped the whole currency picture again. And it's really interesting. There's never been a time in our lives, never mind in our careers, where the Japanese have a hawkish monetary policy and the U.S. has a dovish one.
Yep.
So does that matter to you, or?
Well, I mean, it's certainly driving a huge amount of the volatility here, right? Because people's paradigms are shifting, right? I mean, I think the sort of simplest trade on Wall Street earlier in this year was to borrow in yen and buy almost anything, right?
Yep.
Borrowing in yen just made so much sense, right? Why would I borrow in dollars at whatever Fed funds plus 75 bips is when I could borrow in yen? Borrow at 0 plus 75 bips or whatever my broker's charging me, right? Whoa, holy smokes, I just saved 5% of my borrow costs.
Yep.
It's a no-brainer. And so that type of carry trade driven and leverage driven volatility, the moment it looked like the BOJ was getting hawkish at the same time the Fed was easing, that's what drove that big meltdown in August. But it's interesting there, seeing because Ashiba, the reason the market actually tanked the minute they found out that he was elected was that he'd given all these hawkish statements to the press prior to that. And then the minute that he got in office and the market tanked, politicians react to the market. He comes out and says, "Oh no, I'm not hawkish. I'm dovish."
And told his central banker to go not be hawkish.
Exactly.
But we're talking about relative hawkishness, right?
Right. It's like I'm going to take it from 30 bips to 40 bips or something. You're like, it's a little bit of a different world.
If we can, that's a big thing. If you can get the currency vol and the rates vol out of Japan, and really rates vol has toned down.
Yep.
I mean, the 10-year JGB 10-year notes trading between like 85 basis points and 100 basis points.
Yep.
It's got a 15 basis point what I call risk range. That's tolerable volatility.
Yep.
But I don't want to buy JGBs. Like I own SCJ, which is the small cap ETF.
Yep.
I'm really interested to see what you think of the names in that. I'm sure it's not something you're focused on right now.
No, we own a lot of small cap Japanese stocks, and I like that ETF a lot.
Oh, you do?
Yeah.
Okay, good. Because we obviously look at it before we buy the damn thing, and it passed pretty much every kind of checkpoint that I wanted. That's the most bullish. It's actually the only quad out of the 4 quads that value outperforms everything. Is when you're coming out of a quad 4 into a quad 1.
Yep.
Right, and you're talking about the longest standing quad 4. I mean, in world history is Japan.
Yes.
China looked like they're entering the next one. Maybe they still are. That's a different topic. But they obviously tried to fix that pretty quickly, and most recently talk about positions that consensus gets wound into. But that would be something.
Yeah, but that's
be something very bullish if they were to sustain a quad 1 type economy with a currency that doesn't go. It was most recently at a 38-year low.
Haywire, yeah, and I think that insight is one that we found too. That small cap value outperformance coming out of quad 4, coming out of recessions is the most powerful thing. And if you can get that transition right, it's a big money maker. But there are other periods where small cap value gets crushed, and generally in quad 4 it gets crushed so much.
It gets crushed.
You're basically betting on reversals.
Right, and what I love about your process and all this is that you're so flexible. Like you don't care if you have to go meet with some dude in some nice new building in Japan, or if you go do it. Like, do you care if you go do it somewhere in Europe? No. I mean, what percentage, maybe just to end on this, because I know you have thoughts on how highly concentrated the world's equity exposure is to the U.S.
Yep.
Like, where would you have Japan in terms of your mix relative to that?
Yeah, Japan's maybe 8% of global market cap. We're in the 20s.
20s.
We're very excited.
In a long only or in your long short?
Only. In the long only.
That's big.
Yeah, and I think that's because we look at it and say, where else can I buy stuff where the market cap is more than covered by the assets, right? Forgetting even the operating business, they just sold the assets of the business. But I think that what you've seen is, I think it's 70% of the ACWI is now in the U.S., right? I mean, it's just huge, massive funneling found. And the shift towards passive, which has many good attributes, right? I think the shift to passive has many good attributes. But one of the bad attributes is that when people think passive, they don't think a diversified array of interesting passive indices. they think the S&P 500.
Yeah.
And I think it's something like 70+% of Vanguard's assets are either in the S&P 500 or the Vanguard Total Market Fund. It's something insane like that. So when people are buying Vanguard equities, what they're buying really is U.S. large cap exposure.
Yep.
They're not diversifying, even though they're great passive ways to, the small cap Japan ETF is a great passive way to exploit Japan. But that's not how people actually invest.
Yeah, taking it all the way back to Buffett and Munger, rule number one, don't lose money.
Right.
And then have some diversification. I mean, this is the least diversified, after all these years and all this AI, this is the least diversified and most concentrated that U.S. retirees, the whole kit and caboodle's ever been.
Yep.
So what could possibly go wrong? I mean, with that, I'll thank you for another awesome conversation.
Keith. This was fun.
And everyone should most definitely go get your book.
Thank you, Keith.
I think you can pre-order it.
Pre-order available on Amazon.
And it's he's not in it to sell a book. He's in it to, again, sell a better way is if he's selling anything. And I think that this opportunity, you're going to see it throughout the next couple days here, is what is it that we're actually doing? What is the exposure that they have? What is the difference between being here, in the river? Thanks for joining us. I'll be back with Liz Ann Saunders next.